Stocks up as investors begin looking on the bright side of corporate earnings. Sears Holdings and Lennar both exceeding Wall Street's expectations today. But are we finally seeing some real economic recovery, or is it government-induced? My next guests have some answers and some questions. Charlie Biederman is the chief executive of TrimTab's Investment Research. TrimTabs tracks market liquidity and fund flows on a daily basis. Also, we have with us Tad Rivelle, chief investment officer at TCW Investment Management. His total return bond fund has outperformed 99% of its peers over the past 5 years. Gentlemen, good to have you with us on Taking Stock. Charlie Biederman, I've read some of your most recent notes, and boy, you're laying this rally at the feet of Ben Bernanke and the Federal Reserve. You say it's working, but it's not going to last. Is that really the essence?
Well, that's what happened. QE1 from March of 09 to March 10. It did put some people back to work. It did create inventory restocking. It did bottom the economy. But once the plug was pulled on QE1, the market started to sell off and the economy started to weaken. So in August, Mr. Bernanke said the only thing that's worked to help the economy is let's manipulate the market some more and get stock prices up. It's up over 20%. And we are seeing a little pickup in income. We're seeing a pickup in sales. And, you know, they've spent $600 billion or $400 billion. We've seen an annualized increase in take-home pay of $60 billion. That's not very efficient way of doing things, but it's the only thing that works. And Wall Street is certainly happy.
Tad Rivelle, do you agree? Do you think that this is a Fed-induced rally, at least on equities? And conversely, take a look at what's happened to bond prices.
Well, I think as it relates to the economic recovery, that a good deal of it is in fact artificially induced, not just from the Federal Reserve, but in part due from the very large fiscal imbalances that we're running at the federal level. As most of the viewers are well familiar with, the federal government is spending approximately 25% of GDP in the form of its outlays and taking in something on the neighborhood of maybe 15% in terms of revenue. So collectively, we're running about 10% of GDP in terms of overall deficit. That is a huge number. It's an unsustainable number. And to the extent to which economic growth or economic activity has been propped up as a result of governmental policy, yes, it's probably a near-term rally or recovery that may not last throughout 2011.
All right, so Charlie Biederman, if indeed you and Tad are correct, what's the best way to position the portfolio right now? I mean, what do you do? Market timing is not necessarily a surefire way to make any money. How do you know when the Federal Reserve is going to pull back the money spigot?
You ever see the musical chairs? In this, the Federal Reserve is playing the music, and the investors hope when the music stops, they have a chair to sit on. Or you don't have to play the game. You can get out now. But if you're in business of managing money, you have to invest money. So most money managers I know are very scared and very long at the same time.
Tad Rivelle, what about being in the bond market? Have you seen any pullback on the terms of clients saying, well, take a look at bond prices, maybe we'll come back another day?
Well, the bond market, of course, is a very large and diverse beast. So when we're speaking about the fixed income asset class, it's probably appropriate to speak specifically to the Treasuries or to the mortgage-backed securities or the corporate bond assets.
All right, well, tell us about Treasuries, because if you take a look at the middle duration, right, that 10-year, what are we talking about? 3.4, 3.3% today.
I think what's somewhat shocking about those yield levels is that they reprise levels that we haven't seen since the early 1930s. So what's very interesting about the Treasury market is that, first of all, just looking at it superficially, the yield levels are comparable to where they were after there was the incredible drop-off in economic activity associated with the Great Depression. Furthermore, one might add that the central bank is not really being constructive, at least in our minds, as it relates to valuations, in the sense that QE2 is basically a money printing type of operation. And we already spoke to the deteriorating fiscal balances in the U.S. So it's very hard to understand why the Treasury market should be pricing itself at levels as low as they are currently, but for the fact that the Federal Reserve is, in a sense, subsidizing the overall levels in the Treasury market, subsidizing, in effect, through a zero rate policy in which it's extending credit to the banking sector at 0%, and in a sense allowing banks and other institutions to sponsor treasuries at yield levels that wouldn't otherwise be supported by the private markets. So as it relates to the treasury asset class, we think that valuations are very stretched and that the likelihood of a significant retracement, a shift up in yield over the course of 2011 is very probable.
So, Charlie Biederman, does that mean that maybe you should go out and buy some financials? Tad Rivelle saying at least the banks know how to play this game.
Unfortunately, the banks have, or fortunately for the banks, they've eliminated the need to mark-to-market their assets. There's 7 million homes that currently the mortgages are not being paid, and the banks are collecting interest, not collecting interest, but showing interest income on their income statement, and there's this accrued interest that they're never going to collect. So I don't know what the banks are really worth, given all the stuff about whether or not they'll be able to foreclose, or were the foreclosures good, or I mean, it's a mess. It is a catastrophic mess in the making. And
you think there's structural issues in the economy that are not going to be solved anytime soon?
Rigged markets never end well. And we're in a rigged market. The Fed has admitted this is a rigged market. I've been on your show many times asking where is the Fed's got to be rigging it. People have said, now the Fed's admitted they're rigging the market. How does a rigged market end well? I don't know.
We have to leave it there. I want to thank you very much, Charlie Biederman, coming to us from Trim Tabs Investment Research, and Tad Rivelle from TCW Investment Management.